For our monthly Hashrate Index look back. Kong, welcome back to the show.
Thank you so much, Colin and Charlie. Good to see you both.
Good to see you
Yeah.
too, man.
Okay, so it's July. Summer's, over halfway done, but doesn't mean that things weren't interesting in July. I'll throw it to you. I've got the look back pulled up here. We can hop around to it. Give me the high level TLDR before we go into specific questions, Con.
Definitely. July was quite interesting. So let's start with the headline on hash price. First thing we saw was monthly average dollar denominated hash price rose to $31.21 per petahash per second per day, up 2.8% month over month, but it only recovered a sliver of June's fall. We saw that in June, hash price slipped 17% or $6.23, and July only regained around 84 cents of it. Now, at $31.21, July ranks as the second lowest monthly average hash price on record, behind June, which was $30.37, and just under March, which was $31.27. So these these are the three lowest readings in Luxor's Bitcoin hash price index, and they all fall inside the year of 2026. Now, for comparison, in 2025, monthly averages ranged from around $38 to $59, with a mean of $50.68. So this gives you an idea of what it feels like to be a miner these days.
Yeah, it looks pretty choppy and brutal, man. I just don't see. Do you see light at the end of the tunnel? Is there anything in the look back that makes you think, okay, things could be improving from here? Because to me, the light would have been the 4CP season for the miners who could still remain online. But it hasn't made that much of a difference because so much hash rate's kind of already come offline. Is there anything that gives you hope?
Yes, there is some good news, and I'm going to share some of that right now. But before I get into that, another interesting aspect here is on difficulty. So what we saw with difficulty trends is there was a double drop, which of course contributed to this slight recovery in hash price. During July's epochs, difficulty fell twice. The first was on the 11th of July. It was a minus 5% decrease. And then a second one on the 25th, which was 0.74% decrease. Overall, a 5.71% net decline in difficulty over the month. Now, this trend was driven by 4CP curtailment, and also notably, the July 11 difficulty drop was the fourth largest difficulty decrease of 2026. Now, I mentioned that the trend was driven by 4CP curtailment. How do we know this, or how do we get to this conclusion? The reason is because Luxor's energy desk saw that ERCOT dispatch events clustered heavily across this 10-day period at the very beginning of the month, spanning from the 1st to the 10th of July. We saw that there were more than a dozen curtailment events during these 10 days. And then the following difficulty epoch, spanning from the 11th to the 25th, saw less than half of that and produced a much lower difficulty adjustment, right, from 5% down to 0.74. So the main message here is that curtailment intensity and the size of the difficulty adjustment tracked each other pretty closely. Another interesting insight, which I think is highly relevant, is at this stage, difficulty has now closed below the 1 zeta hash equivalent, which comes out to 139.70 trillion for 10 consecutive difficulty adjustments, spanning from the 20th of March to the 25th of July. So right now in early August, it's been over 130 days where we've firmly been below the 1 zeta hash milestone. And then a third distinction between the previous month of June and this month of July was that the difficulty drops that we saw in June coincided with two different factors. One was record low hash price, which caused marginal mining machines to shut down. And then there was also seasonal curtailment via 4CP, peak avoidance behavior for flexible loads. July saw hash price rise by 2.8%, which removed some of that economic layer. So that's why we're coming to this conclusion that the trend was driven by 4CP curtailment. Of course, we can't be absolute about it, but we believe that it was a significant contributing factor.
And this actually gets into something I think you've brought up in the look back, which is we peaked last year at like 1.1 zettahash, and we're down to the average moving average is the mid 900s or low 900s now of exahash, which means there's an estimated 227 exahash idle. Pretty interesting here. Any like color you can give to this? Economically unviable? Is this just rotting? Is it? What are the implications of this for the foreseeable future?
Definitely, yeah. So that's an interesting observation that's been driven by our latest mining economics projections. And basically what we're seeing is that since that peak of the 1 zettahash milestone back in around September, October of 2025, difficulty peaked around 155.97 trillion, I believe. We're down around 19% from there since then. Throughout this time, going back to what Colin just talked about in terms of good news, what this means is for any miner that's online and still hashing, that's relief, right? The Bitcoin network is paying more BTC per unit of SHA-256 hash rate at the moment for those that have survived and stayed online. Another interesting insight that we can draw from our projections is that at a price range right now of between 59 to 66K in terms of Bitcoin price action, we would expect USD hash price to range in the $28 to $33 range. Now, that's above the level that triggered the marginal shutdowns in June, but it's not far enough to bring back mid-generation mining machines back online. So we're talking about the 25 to 38 joule per terahash tier. So Charlie, a lot of that idle capacity is coming from this mid-gen mining machine tier. Even more interestingly, at $40,000 Bitcoin price, our sensitivity tables would put equilibrium hash price around the $25 mark per petahash per second per day. And what we think is that the price point that really, really matters is around $33,000 for Bitcoin, because at that point, assuming an average industrial power cost of $48 per megawatt hour, we would see that the break-even efficiency would drop under our estimate of the network efficiency, which is around 20 joules per terahash. So the message there is that the median machine would stop covering its power bill at that point. So the differences in idle capacity versus active hash rate and these sensitivity estimates gives you an idea of where we're sitting right now and how Bitcoin price action might affect hash rate.
I've got kind of two questions to follow up on that, Con. The first one involves the machines that are still active. Because right now, break-even efficiency at July's hash price is like 27 joules per terahash, assuming like $48-50 per megawatt hour. And the 25 to 38 joule per terahash tier has sat below break-even for 2 straight months against an estimated network average cost that was just mentioned. Do you think we've reached a kind of ceiling for hash rate for right now, in the sense that like we're kind of getting to that point where equilibrium is setting in, the machines that are still online are the only ones that can take it, the operators that can't hash profitably under this hash price are gone? And the second part of that question, are there any insights from the ASIC trading desk as to like where that 227 exahash is going to go? Is that just scrap at this point? Like, is there any room for that to migrate to lower cost jurisdictions? So just two parts there. You can tackle them in whatever order you want.
Yes, really good question. First is on the idle capacity. This idle capacity could be idle for reasons beyond economics as well. Some machines fail. We know this. Eventually, all machines will fail. And some might be going under maintenance, or as you mentioned, Colin, they may be moving elsewhere around the world, chasing the cheapest electrons. So it's a confluence of these factors. And then the second part to your question is a lot of our estimations for these mining economics projections are driven by insights we get from our hardware team And specifically for our latest run, we saw that there was a major downward revision in terms of monthly production estimates for incoming hash rate supplied by ASIC manufacturers. And the reason is quite clear. Excuse me. The reason is quite clear. Mining economics has deteriorated quite a bit. So machines are incoming at a slower rate, which of course affects the level of hash rate supply coming in as well.
So I want to talk about hash rate contracts and how hash rate traded. Always a really interesting thing to have you look at, especially in the middle of the summer. Yeah. I guess first, how did hash rate trade, and then we'll get into how the hedgers performed.
Yeah, good question. So how future hash rate traded throughout the month was, we saw that the forward market lowered its difficulty and hash rate expectations again in July, deepening rather than reversing the reduction it made in June. So every forward contract from August to December fell by an average of around 6%. And the implied network hash rate for end of year, December 2026, dropped from 1.05 zeta hash to now 985 exahashes. So Colin, touching back on what you just mentioned, the forward curve is expecting hash rate to remain below the 1 zeta hash level throughout the end of the year. And then second, Charlie, when it comes to hash rate hedging performance, what we've seen is, instead of looking at single month contract performance, I think it's more interesting to look at rolling hedge performance over different time frames. Two main messages here. The first is that over the past 12 months, the trailing 12 months, it's generally made sense to hedge against dollar denominated hash price and to remain exposed to spot Bitcoin denominated hash price. This is driven by two different factors. First is weak Bitcoin price action, which obviously affects dollar denominated hash price. And then the second is the decline in difficulty that we've seen, which relieves Bitcoin denominated hash price. So generally, dollar denominated hash price hedgers have won, and those remaining exposed to spot Bitcoin hash price have also won throughout this period. Now, if we zoom out further to the halving since April of 2024, the picture changes a little bit. The main message being there that regardless of your hedge horizon or your contract denomination, it's generally made sense to hedge against hash price. So as a group, miners that have engaged in consistent hedging have come out on top versus spot mining alone.
So let's get into how the USD and BTC denominated sellers performed. It looks like USD won 2 out of 5 horizons. So
that's correct.
Dive into this for me.
So for this month in specific, dollar denominated hedges won throughout April and May, and any hedge struck outside of that time period was out of the money. And conversely, on the Bitcoin denominated side, buyers of Bitcoin denominated hash price won across the board. For the fourth consecutive month, anyone who's selling forward in terms of Bitcoin denominated hash price has been out of the money. And the reason is because difficulty is declining. So why would you hedge against difficulty or transaction fees as well? And there's some interesting insights on transaction fees that we can touch on as well. Of course, there's a very relevant exploit which shows up through these on-chain signals.
I assume you're talking about the cold card exploit and specifically increased fees from sweeping those funds.
Exactly, yes. The data clearly showed up towards the end of the month. So throughout the month, fees accounted for 0.69% of total block rewards. This is still below 1% for a 13th consecutive month. So we've seen this trend since July of 2025, bone dry fees. In terms of dollar denominated terms, average fee revenue per block came out to just under $1,400 per block 8% decline month over month. And the estimated network-wide fee revenue for the full month of July was around $6.2 million. Now, the fee distribution was heavily skewed towards a single day, and we believe that the cause was the cold card exploit rather than organic block space demand. We saw that on the 31st of July, fee collection peaked, which was 67% above the monthly average. It also saw the highest fee revenue per block, coupled with the lowest transaction counts of the month. So the 31st of July saw an average of 3,900 transactions per block against the monthly average of 4,700. Why is this the case? It's because sweeping thousands of compromised addresses into a handful of consolidation addresses produced a small number of input-heavy transactions. So block space was being filled with these handful of very large, heavy transactions rather than many ordinary ones. And miners were able to capture some of this fee competition. But yeah, safe to say that the data showed quite clearly that something happens towards the end of the month, and we attribute it towards this cold card exploit.
An unfortunate note to end on, but salient insight. Khan, thank you for joining. Really appreciate it. We'll be looking forward to next month. See if hash price improves, and we'll see if that ceiling on hash rate holds. Have a good weekend, man. CleanSpark is a market-leading data center developer with a proven track record of success. NASDAQ CLSK.